Good afternoon, Michael Shotnik with Sierra Pacific Mortgage. Here today to talk to you about mortgage insurance and having it removed. We're going to talk specifically about conventional loans. Those are the most broadly used types of financing. So we're going to hone in on conventional loans today. And there's a lot of fine print. We'll just put that out there immediately involved with having mortgage insurance removed. Each mortgage insurance company is a little bit different. Each lender has slightly different requirements. So we'll be talking kind of general rules of thumb today. And simply put, there are different thresholds or different instances when you can have mortgage insurance removed. So scenario one would be you purchase a home for say $100,000. Let's say you put 3% down, so less than 20% mortgage insurance would be required. So right out of the gate, day one in the home, you owe $97,000 on a $100,000 property, so you're at 97% of the value. The fastest way to have mortgage insurance removed would be to pay the balance down to 78%. So that's $78,000. As soon as you do that, you can apply to have mortgage insurance removed. It's a manual process within the first couple of years to have mortgage insurance removed if you pay the balance down. But the key threshold there is 78%. The second, or the alternative to just naturally paying the balance down, and let's clarify one thing before we move on real quick. The value is driven by the original sales price within the 2-year timeline. So within that 2-year timeline, you're trying to get to 78% based on the original purchase price. So again, $100,000 being the purchase price in our scenario, you need to pay it down to $78,000. The second threshold is the 2-year mark. At that mark, the parameters will open up for you in that you can have an appraisal done to determine fair market value of the property. And at that point, based on a new appraisal, you would need to be at 75% of the fair market value. So first couple of years you're paying the balance down, the value of the home's going up. When you hit that 2-year mark, chances are in an appreciating environment, you're going to get to that threshold. So again, 75% within 2 years, you're going to get to that threshold before you kind of naturally pay down to 78% of the original purchase price. So 2 years, a big mark there. And then the next big threshold is 5 years. At the 5-year mark, if you haven't paid the balance down or didn't apply at the 2-year mark, and of course you can keep applying or apply again. But at the 5-year mark, the requirements are lower in that you have to have 20% equity based on fair market value. So over 5 years, you're paying the balance down, hopefully value's going up. So there's a really good chance at that 5-year mark via an application to have it removed, you can have it removed. Again, each investor's case by case. I highly suggest you reach out to us first. We'll do an AVM on your property, an automated valuation of your home, and then we'll look at the balance of your loan and determine if it would be worthwhile for you to pursue the process, because it is a small process. In addition to that, it might not be a bad idea to talk to the real estate agent you purchased the home with to get their idea of value. And if you have any additional needs, so if we think that you could improve your interest rate and or access the equity in your home, there's a lot of different needs you may have. It would be worth evaluating in full up front before you go down the process. Again, Michael Shotnik, Sierra Pacific Mortgage. You can reach us here at 303-800-4595. Thank you.